Hey students, this is week one. We're getting ready to start here, and I just want to go through a kind of an overview of what we're going to be studying. And this is out of chapter 8, out of the Price and Needles books, which you've been reading already. So this is again a continuation from Accounting Principles 1. We're now Accounting Principles 2. Out of chapter 8, so we're going to be looking at the components of internal control, some control activities, and limitations on internal control. We're going to be looking at the fact that control activities are pretty common in merchandising transactions, specifically the inventory side of merchandising. And then we're going to also be looking at cash equivalents and talk about methods of controlling cash. The thing I want you to focus on for this week and really for chapter 8 is to think about a lot of these controls as a process. So there are steps that you take. There's a process you go through to do these controls. They're not just policies and procedures. They're really steps and actions that you have to take. Some of the terms that we need to get to know are faithful representation. So you'll hear that throughout the chapter. It's the characteristic of information, the qualitative characteristic of information that has to be complete, neutral, and free from material error. If you recall from earlier chapters, I believe that the level was 5%. So if anything was more than 5% in error between actual and what was found during an audit, then it would be less than a faithful representation. Less than 5% auditors don't usually worry about. Management might, but auditors don't. So, but that whole idea of faithful representation is that financial information has to be correct within a certain tolerance band. It has to be correct and free from error. So more terms include internal control, and again, this emphasis on the word process. That's there to achieve the goal by establishing reliable accounting records and financial statements. So it really is an assurance that the company's assets are protected. So internal control acts as this shroud, if you will, around the company's assets. Physical inventory is another term and an action that has to take place, especially when you have lots and lots of inventory. You wouldn't necessarily do this in an office environment. You might, but probably not. But you definitely do it in like a retail setting or in a manufacturing plant. You would do some sort of physical inventory, and it's a physical count of all the items, all the SKUs, and then compared to what you actually have on the books. And then you have to make adjustments. So sometimes you have gains. In other words, you have more inventory, physical inventory, than you had recorded, and sometimes you have less, which is a loss. Those are never fun. Most companies experience losses. And as they say on this slide, from spoilage, shoplifting, and theft. That's kind of in a retail setting, but in a manufacturing plant, oftentimes the losses are simply from just miscounting, or sometimes people will pull a piece of inventory off the wall and not properly record it. So it can result from those things that they call honest mistakes or incorrectly tagging inventory. So a periodic inventory system provides no means of identifying these losses because the costs are automatically included in the cost of goods sold. So there are adjustments made in a period. When you do a periodic inventory, you often have to make adjustments. And when you do a perpetual inventory, it makes it easier just to identify these losses because it's like perpetually correcting itself as you go. Some more things to study. We're looking at not so much terms anymore as we are notions or concepts. This concept of control environment. It's overall attitude or awareness of actions. If you remember the back to the Enron video from remember in chapter 1 or 2 now, I don't remember from the book, from Accounting Principles 1, when we ran across this, but their attitude in terms of managers was pretty poor. They had an attitude, in fact, an environment of deceiving people. This control environment is really set by the company's ethics, their policies, their culture, their organizational style, etc. The idea of this risk assessment involves identifying areas in which there's risk of loss of assets or inaccuracies in accounting, and they're actually high. So you do this risk assessment to know, is this going to be an area where you do a risk assessment by department, if you will, and you identify, hey, is this going to be a particular area where we have to watch and be careful? Sometimes the controls in one department are less than, because there's less risk. Sometimes the controls are higher. Whenever you think about an accounting department in a place of business, the risk is pretty high. And so there's a lot of financial controls put in place on the people who work in the accounting department. Risk assessment for, like, say, the top management, it does. I mean, there is risk there for sure, but oftentimes their access to the money isn't as readily available as it is to people in the accounting department. So probably a little bit less risk in terms of higher executives. And then they can make poor financial decisions, but like in terms of fraud, not necessarily. Control activities are, again, policies, procedures that leaders put in place to make sure that directives are met and things are carried out. There's information and communication, some more components of controls, internal control, the whole monitoring, management's regular assessment of the quality of the internal control, periodic review of compliance. And I can tell you, if you don't do this as a management team, if you don't monitor, then somebody else will do it for you if you get it wrong. Because if you're a public held company, you have requirements that you have to make for monitoring. And if you don't make them, you get people will come in and help you, quote unquote, help you. So monitoring is a big part of management's responsibility when it comes to internal controls. And the goal of any control activity is just simply to safeguard, again, shroud those company assets and make sure that the accounting records are as accurate as they can be to the standards that are put out there. Let's see, some more things around control activities would be like physical controls of either cash, inventory. If you've ever been into a retail store, you know they've got those metal detectors at the gates, you know, going in and out. Just last night, as a matter of fact, my wife and I were shopping. We were at a TJ Maxx, and we were hanging on to a coffee pot, and we were like near the door. We weren't leaving with it, but we were near the door, and we had met some friends near the door on the inside of the store. We had this new teapot is what it was. Had this new teapot with us, and there was a security guard standing right there to make sure that we weren't going to walk out with it. She was standing like not more than 5 feet from us. Of course, we had no intention of walking out with it. But as soon as I turned and walked back into walked back deeper into the store, it wasn't an issue anymore. But she was definitely there. That's an example of physical control, those metal detectors and whatnot. There's also this idea of separation of duties. And there's a slide, I'm going to show it to you right now, as a matter of fact. So separation of duties, especially in larger companies, is a must. It's very difficult to do this in smaller companies because you have so many people wearing multiple hats in smaller companies. It's a little bit difficult to do this, but just look at this green box for just a second. You'll see that there's the accounting department and there's purchasing. So accounting can't issue purchase orders to vendors, for example. It has to go through a purchasing department. So the people who control the money cannot issue purchase orders to vendors. Otherwise, you set up a possibility of some fraud. Same thing with the receiving department. The receiving department, receives the materials in, checks it in, makes sure it's what was ordered. Again, accounting does not have access to receipt materials in. That's only done by the receiving department. And verification of the goods received is done by, say, some department that requested a material be ordered. This department actually confirms it's ordered. So again, accounting is taken out of the loop. So you can kind of see, to protect the assets, accounting itself, the accounting department is put into this bubble, and they can't get out and do much on their own without working through other departments. So again, it's this whole idea of just protecting people and having separation of duties. I would tell you, in my experience, most people want separation of duties. They don't want to be accused of anything, of mishandling assets or keeping records incorrectly. They want separation of duties. In smaller companies, this becomes a little more difficult because somebody in the accounting department may also work in the purchasing department. So most times you have to work your way through those things. This idea of bonding or double checking someone's background is always a good idea. If your company doesn't do that, they ought to. You don't want to put anybody in the accounting department who's had a background in fraud. One example from our company is we have an employee who came to us, we hired her, and she has a background in fraud. She went to prison for a couple of years because of some fraudulent activity. She was put in a position where she worked before, where she was too close to the money. They had financial issues at home. And I don't know how much money she took, but she took some. She got caught, sent to prison. Well, she works for us now, but we don't, because we wanted to give her a second chance. She didn't work for us when this happened in her life. It was like a number of years before at a separate company. So we thought it had been long enough, we'll give her a chance. And she's working out fine, but we don't let her near any money whatsoever, just so that she's not tempted by that. So this whole idea of bonding is pretty important, that you do that with wherever you work. And then finally, the whole idea of internal control and these objectives behind internal control is that we have a system. And then I want to emphasize the word system. It's not just thrown together. These things actually work in conjunction with each other to control the merchandising activities and controlling the inventory. There's some important objectives that need to be accomplished: preventing loss of cash and inventory. Remember, inventory is not quite as liquid as cash, but it certainly should be treated the same as cash. So whenever you go out on a plant floor, whenever you go into a retail setting, all the material that you're looking at on the racks or on the walls is cash, and it's just cash purchased inventory. It's just sitting there waiting to be used. It has to be protected. So you're all about preventing loss of cash and inventory, ensuring records of transactions are accurate. You got to keep enough inventory in hand to sell to customer without overstocking merchandising. That's kind of a separate course, but I'll tell you, too much inventory is a real problem. You have your cash tied up with inventory that you may or may not be able to sell, that will be spoiled or goes out of date, and then you can't sell it. You might as well put a match to the dollar bills that you have tied up with this inventory, because you won't be able to do anything with it. You also want to keep sufficient cash on hand to pay for purchases, but listen, you don't want to have too much cash. You don't want to be just a bank sitting there waiting for someone to come along and take it. So, and then you also want to keep credit losses as low as possible by making credit sales only to customers who are likely to pay on time. We use a lot of credit cards in our society, and sometimes merchants are left holding the bag, or credit card companies are left holding the bag. Okay, I think that's it for now. Make sure that you are reading the chapters. Let me pull up the week 1 module here. So this is week 1 module in Canvas. Make sure you're reading chapter 8, sections 8.1 through 8.5 is what we're talking about this week. Hit the discussion questions. The participation question this week is about you. And I know I've had you guys before in class, but you know what? Tell me what you're going to do with this accounting knowledge in this course. What are you going to do with what you learned? Tell me something you're concerned about. What's another question maybe you'd like to ask me that maybe you haven't asked me before in the past? I don't know. And then office hours. Just flip back to the syllabus real quick. So office hours are on Wednesday evenings at 7:30 Arizona time. So, okay, I think that's it. Be sure to give me a shout if you have a question other than office hours. You don't have to show up for office hours. It's optional, obviously. And remember, God is on his throne. He's always been there. He's always going to be. Have a great week.